Hello and welcome back, guys. So in this particular session, what we'll be doing Fernhurst company, right? So it's September December 2016, and then Fernhurst company is a manufacturer of mobile communications technology. Manufacturer of mobile communication technology, right? It's about to launch a new communication device, the Milland, which its director believe Milanda, the communication device, which is director's belief is both more technologically advanced and easier to use than the device currently offered by its rivals. So technologically advanced and easier to use, right? People always love when there is something easier to use. So investment in Milan. The Milan will require a major investment in facilities. Furnace company's director believe that this can take place quickly and the production can be started almost immediately. This will be in your assumption. Always state that. Similar sort of question, right? Right. This will be your assumption. That normally, definitely, like it does not happen in real life, but yeah. Right. It does not happen so quickly, but yeah. Furnace expects to sell how many units? This many units in the first year. And then sales volume is expected to increase by 20%, 30%, and then it will be same in year 4 as year 3, and then the product reaches its end of its useful life. What is its useful life? Is 4 years. The initial selling price in year 4 is $100 per unit, and then before increasing the rate annually. Okay, in year 1 is this much. Okay, with the inflation, right? Variable cost is expected to be this much in year 1, rising by the rate of inflation in subsequent years annually. Fixed costs are expected to be this much in year 1 and then rising by the rate of inflation subsequently, right? The initial investment in non-current assets, NCA, is this much non-current assets, and furnace company will need to make an initial investment of this much of working capital, which will be increased annually at the start of each of year 2 to. So immediately they will need this much, will be increased annually at the start of years 2 to 4, not year 1, just year 2 to 4, and is fully recoverable at the end of the project life. Furnace will also incur one-off marketing expenditure 1.5 million post-inflation. After the launch of the billion, the marketing expenditure can be assumed to be made in the end of year 1. Okay, and be tax allowable expense. Okay, that's good. Easier to calculate, right? So pays a company tax profit of this much. Tax is payable in the year the tax liability arises. Tax allowable depreciation is at 20% on the investment in non-current assets. Non-current assets is what, 16,000, and then on a reducing balance basis. Okay, that's important. Reducing adjustment will be available. Balancing adjustment will be available in year 4. The realizable value of the investment at the end of the year 4 is expected to be 0. Okay, so balancing adjustment will be the remaining value. The expected annual inflation rate in Furnace company is basically 4% and then 5. Okay, so that's adds a bit of complexity, but still it's fine. So applicable cost of capital for the investment appraisal is 11%. Other calculation. So Furnace company has indicated that besides needing a NPV calculation based on this data for the board meeting, he also needs to know the figure for the project duration. Okay, duration has to be computed. That is what duration was, present value into your years divided by your total present value, right? To indicate the board how returns will be spread over time. Just checking the requirement. Yeah, I should have started with that. So evaluate is basically we need to assess, and then we need to comment on as well, right? Financial acceptability of the investment in Milan, and calculate and comment on the investment duration. Calculate and comment. Okay, we just need to calculate and comment on the investment duration only. So B is calculate the percentage change in selling price required for the investment to have a net zero net present value, and discuss the significance of your result. Discuss the NED's understanding of NPV and explain the importance of other measures in providing data about investment short and long-term performance, about an investment's short and long-term performance. Importance of other measures, right? So that is also very important thing. But yeah, let's see. So failure of launch of Milan. The finance director would also like a simple analysis based on the possibility that the marketing expenditure is not effective and the launch fails, as he feels the product price may be too high. He suggested that there is a 15% chance that Milan company will have a negative cash flow for year one of this much, and he would like to know what percentage the selling price could be reduced or increased to result in the investment having a 0 NPV, assuming demand remained the same. Okay, unit is basically same. Assessment of new products, right? So Fernhurst last BOD meeting discussed another possible new product, the Reacton, and the finance director presented a range of financial data relating to the product, including the result of NPV and payback evaluations. One of the NADs, who's not a qualified accountant, stated that he found it difficult to see significance of different items of financial data. His understanding was that finance had to ensure that investment had a positive net NPV and shareholders were bound to be satisfied with it, as it would maximize their wealth in long term. The finance director commented that in reality some shareholders looked at the performance of the investment which Furnishco made over the short term, and whereas some were concerned with the longer term. The financial data he presented to the board includes short term and long term measures. Okay, so we have to discuss about that as well, right, for NED, for third component. Okay, so let's do it. What are we waiting on, right? So let's do it. So Furnhurst company. So what's the key answering tips? Very standard investment appraisal question. Note that part A requires you to calculate duration as well as NPV, but once you forecast the free cash flow from the project, this should be a simple extra step. So part B is standard sensitivity calculation. The easiest way to calculate the percentage sensitivity is by using NPV divided by your present value times 100%, right? When attempting to answer this in CBE, make sure you split the function like sum and then NPV to save time. Okay, so let's calculate the sales revenue first of all. So sales revenue is what? Sales revenue is 132,000 units times the 100, right, selling price, and then it's going to inflate annually, right? So times 100, 132,000 times 100, 132,500 times 100 in the first year, right? In the second year, it's going to inflate by how much? What's the inflation rate? In year 1, it's 4%. In year 2 to 4 is 5%. So into 105 into, why are we doing 1.2? Sales volume will also increase, na? That's why we are doing that. So 132,500 times 1.2 times 100 times 1.05, right? So inflating the price, and then we are inflating the quantity as well, 1.2 into 1.3, right? Similarly, in the year 4, what's happening will be same. Okay, so it's just going to be same amount, right, in terms of that, but the cost, the selling price will increase. The quantity will be same, but the cost will increase, the selling price will increase. Okay, so we've got our selling price, right, I mean revenue, and then we calculate the variable cost. Variable cost is 4.68 in year 1, and then rising by the rate of inflation in subsequent years annually. So 4.68 times 1.05 into 132 into 1.2, right? So we have to increase the volume as well, I mean in second year. Yeah, in the first year it's just going to be simple. Similarly done, right? Same as sales revenue. All right, for what else? Just plug in the values, we get our contribution margin. We need to add in the marketing expenditure over there. Remember, marketing expenditure one-off marketing expenditure of 1.5 million or 1500. This is in thousands, right? Did they talk about fixed cost? It's going to be 900 in, and then rising by inflation subsequently. Okay, so 900 and then 900 times your 1.05, 945, all these values, right? And then we need to calculate the tax allowable depreciation. Tax allowable depreciation is 20%. So 16,000 times 20% is 3,200, right? So 3,200, and then your remaining balance 25% on that, and then everything over there. At the end of year 1, year 4, what will happen? You will have a balancing allowance of how much? The whole amount, right? So otherwise what you could also do is 8192 times 25%. What is that value? 8192 times 25%, 2048, right? What's the value remaining? 2048 minus 8192, 6144 is the remaining balance, right, at the year end. But we are basically, what's happening over there, we will be getting where was that remaining tax allowable depreciation, and then the balancing adjustment will be available in year 4, right? So that means we can claim this amount plus the depreciation for the year as well, right? So we can basically, so if you add this thing, you will get 8192. Okay, from my approach, how we used to do it, how I have done it. So if you got confused, don't worry, got a video on this thing as well, how to calculate TAD. On that I've explained it as well. Okay, so we do all the depreciation amount, just plug in the value, we get our taxable profit, our tax base, right? And then after that, in the last year, we are getting balancing allowance, right? And then we have our taxable profit, just charge 25% tax on it, and then add back the depreciation, because they are not saying like we will need that same depreciation as an expenditure to maintain or for non-current assets replacement, right? They have not told us. So we basically add it back. We assume that it's not being expensed. Okay, so we get our cash flow after tax, and then we put in the investment of how much? 16,000, right? And working capital, we need to adjust this value. Be careful on this thing, because there was a bit of a caveat over there. 1025 is our initial investment, initial working capital, right? And then what does it say? The working capital will be increased at the start of year 2 to year 4. Okay, so in year start of each of year 2. So start of year 2 means end of year 1, right? So that's why we need to just increase it. So what's the working capital? 1025, right? So 1025, and then how much should we increase it by? What does it say? Inflation rate, right? Inflation rate. So 1.05. So it should be 1025 into 1.05. So 1076. Or let's just say 1076, right? So what's the difference? 1025 in the first year, in the second, in the 0 year, and then in the first year it will be minus 1025, right? So 51.25. How did that differ? Okay, you know what happened? Because in the first year the inflation is not that much, nah? That's why it's 1 point. Where is inflation? It's 4%. Okay, so that's why they've given that 4%. Otherwise they would not have given. You see, because the working capital requirement is increasing by 1.04, so 1066, so it's 10 less, that means 41. You see, that's how they trick you. That's all, just to trick you, nothing else. That's just given just to trick. All right, so it's easy to miss it out. 1066, and then after that what? 1025 into 1.04, and then 1066 times 1.05 in the next year, right? 1119, right? So in the first year, how much will be the difference between this amount and this amount? It will be 41, difference between this amount and this amount, 66, so means 4, 34, and then 19, right? 34 plus 19 is 53. That's the requirement. And then in the third year it will be 1119 into, what the hell, 1119 into 1.05, we are getting 1175, right? So this is year 3. 1175, right? In that period, the difference between that is basically 19, right? 20 is 55, 56, so it will be 56. And then in the last year it will increase also, but we don't need that because we'll be recovering all these things. So we just add all this thing up, we get 1175. Okay, so that's pretty much it. Nothing, not a big deal, right? Okay, so that is also done. Then we get our cash flow, right? Just add in all this thing, working capital, initial investment and working capital. Always remember, sometimes they tell you like they have to raise a debt or something. Whenever they say like for the investment, for the whole thing, you add in the working capital as well. Not only for the investment, you add in the working capital. We assume like we don't have the money for working capital as well. We take loan for everything normally, okay, if they say so. Okay, and then discount factor, we discount it what rate 11%. So 1 by 11, 1.11, 900, 901, right? So 3 digit, and then we get our present values, all this thing, right? So we have our NPV of positive, so that means the project should be undertaken, right? Just comment on it. And then we need to talk about duration, isn't it? Duration, where is that given? Comment on investment duration. We need to calculate and then briefly comment. So a duration is always computed as like present value of year 1 plus present value of year 2 times your time 0 or time 1 times your T2, all this present value, divide by your total present value. They've done it a bit differently. What they have basically done is they've just done like present value divide by your total present value, and then you just multiply it with the year. That's what they have done. You could do it anyway, because if you're you're solving this equation, you will get the same thing, this thing. Okay, so it's very not so hard, right? So it's basically present value times your year. Present value times your year, divide like present value times present value in year 1 times your T1 or your year plus present value 2 in year 2, I mean, and then present and then the year plus this thing, right? And then after that it is divided by total present value. Okay, so if you try and solve this thing, you will get same thing. Okay, you could do it this way as well. This way is also fine. What they have basically done is you just bring in the present value from the top, all these values, right? And then what do? You get the proportion of it. So how do you get the proportion? Percentage of the total present value. So 4104 divide by the total of all this thing. So 4104 plus 5627 plus 6826 plus 8269, right? So 24826. So 4104 divide by 24826. So you're getting 16.5, right? And then you get the proportion of it, and then you multiply it with the year 1, 2, 3. So this is coming in year 1, right? This present value. So you multiplied with the duration, your year, okay? And then in second, for second, you do the same thing, okay? Or either if the method that I was saying earlier was basically the other method, where like what you could do is basically you could just do it this way as well. 4104 times 1 plus 5127 times 2 plus 6826 times 3, and then all this thing you divide it with 24826. Okay, so let's just see. 4104 times 1, that's 4104 had, right? And then 5167 times 2, just add in, and then 6826 times 3, add in, right? And then after that 8269 times 4, add in. The total is 67,999. So 67,992 divide by 24826. Divide by 24826. You get 2.74. Okay, so similar along this line. Okay, so this is different over here because they took a proportion at the beginning, and this is also rounded off figure, that's why. Okay, otherwise nothing else. Yeah, you could do it that way. You see, they've told you over here as well. Okay, that's for selling price. Okay, not for this thing. Okay, so that thing is done, and then we need to comment on it. So the result indicates that it will take 2.78 years to recover half the present value of the project, right? To recover half the present value. The duration considers the time value of money, right? The other methods, they do take consider of the time value, but they do not. The discounted payback period takes the time value of money, but it does not take account of all cash flows of the project. Only the duration does it. You see, it's calculating based on this. The other discounted payback period and normal payback period does not even take account of the time value of money, but discounted period takes time value of money, but it does not take into account of all cash flow. Okay, that is only done by duration. Always remember. That is another thing that I wanted to tell. And then next question is the percentage change in selling price required for the investment to have a NPV of 0. Right, and then discuss the significance of your results. So we need to discount the revenue by how much should it fall, the selling price, to get a value which is where NPV will be 0, right? So in order to do that, we have our revenue, right? Revenue, and then what we can do is how much do we need right now? What's our value? It is what's our current value from all this thing? 4104 plus 5627 plus 6826 plus 8269, right? So 24 all this thing, right? 24826. Right, in order for it to fall, how much should it fall by? How much is the proportion of it? How much is the after tax? Divide by 13,250. Let me just calculate that. Yeah, so yeah, we were over here, right? Yeah, okay. So in that case, basically all we need to do is discount the revenue, right? But how are you going to, so how much should the selling price be reduced by, right? So you can compute that. Basically, when does that happen? You see, basically when your initial investment minus your present value of cash flow should equals to 0, right? Then only the NPV, that's the thing when you will have a NPV of 0. So present value of cash flow, right? So the present value of cash flow should decrease by how much, right? How much proportion of that? So for that, what you can do is basically find the NPV, divide by your discounted, or let's just say sales. Okay, so you can just say NPV divide by sales into 100%. Okay, so in that way you can find how much should the value be reduced by. When I'm talking about sales over here, I'm talking about discounted sales value, huh? After computing the taxes and everything. Okay, after computing the taxes and everything. Okay, so it's always this, in this kind of question they always ask. Okay, so that's how you can basically do that. So for that, what do? We get our sales revenue times 0.75. Why is that? Because the tax rate is 25%. That's why we need to account for the tax rate as well. Okay, and then this is for your discount rate, right? So your normal total sales will be this much, right? So the reduction in sales price is how much? How much should the sales price be reduced by? It is basically your NPV divide by your sales, total sales price, right? So this is the total sales. Out of the total sales, how much should it reduce by? It should reduce by 18%. So it should fall down to, let's say, 43,441 minus 18%. Right, it should fall down to 35621. 35621.6. Right, it should fall down to 35621.6, all this thing, right? So it should fall down that much. Okay, then what we need to do? We also need to discuss the significance of your result. So it has a cushion over there for 18%, right? So it's a cushion. I like to call it cushion because the company has a probability of reducing the selling price if there is more competition and all, right? So I would say, what does the thing say? Fernhurst would appear to have some scope to reduce the price in order to guarantee the success of the product launch. So there is some scope. Of course, there is 18%, right? So it would be useful to know whether the director's view on the success of the product would change if the product was launched at a lower price, right? So director's view of success could change if it was thing. Okay, so they are associating it with this thing, the failure part, this part. Okay, you see how they are answering. And there may be a scope at launch to launch at a price which is more than 18% lower than the planned launch price, and the increased sales price subsequently by more than the rate of inflation if the launch is success, right? So there is a possibility of that. So if the directors are unwilling to reduce their price, then their decision will depend on whether they are willing to consider other ways of mitigating a failed launch or take a chance that the product will make a loss and be abandoned. They will need to take into account that a probability of 15% of the loss and the magnitude of at least 100,000, 1 million, but possibly higher. Presumably, the director's assessment of the probability of loss is based more on doubts about the demand rather than the level of cost. Right. Demand for it, right? Rather than the cost, because based on that cost you'll have some demand level on it. So may consider a smaller scale launch to test the market, and then after that it could still be left with expensive facilities if the product were abandoned, right? The decision may therefore depend on alternatives available which could be made to the new facilities, which could be, how it can be utilized. Alternative uses could be made of the new facilities. Even if it fails, the facilities will be there with us, right? So how can we do that? We could think about that as well along those lines, basically. Right, anything else? Okay, we need to explain NED about understanding of NPV and explain the importance of other measures. Okay, so NED has highlighted that the importance of long-term maximization of shareholders' wealth. The NPV is the most important indicator of whether an investment is likely to do that. However, the assessment of investment using NPV has been modified if the company is undertaking a different investment. Has to be modified if the company is taking number of different investments and then capital is rationed, right? It's not necessarily the case that the investment with highest NPV will be chosen as account has to be taken of the amount of capital investment invested as well, because if you are just taking only NPV, you are not looking at the actual return of it, right? So we will need to take account of the capital that is being invested as well, right? Not only highest NPV. However, investors are, because you might not have the capital available as well, right? Even if you're looking at a highest NPV, because you will need to have those funds. However, investors are not necessarily concerned solely with long term. They are also concerned with short term indicators such as annual dividend, right, which the company can sustain. This may be concerned if the company investment portfolio is weighted towards projects which will produce good long-term returns but limited returns in the near future. They may be concerned if the company's investment portfolio is weighted towards project which will produce long-term returns but limited returns in the near future. So that will be a bit of a problem for investors who are looking at dividend or short-term gain as well, right? So risks will also influence shareholders' view. They may prefer investments which where a higher proportion of returns are made in the short term if they feel that higher returns are much more uncertain, right? So if there is uncertainty, they would demand higher returns. That's what it basically tells, right? So the NPV calculation itself discounts longer term cash flows more than short term cash flows. What does it say? The NPV calculation itself discounts long-term cash flows more than short-term cash flows, because your discounting factor will be less when the time frame increases, right? Your discounting factor, remember, you're discounting by smaller number, right? So the money which is after 40 years is worth very less right now, right? The payback method shows how long an investment will take to generate enough returns to pay back its investment. The payback method, right, shows how long an investment will take to generate enough returns to pay back its investment. It favors investment which pay back quickly, right? Although it fails to take into account of the longer term cash flows after the payback period. Duration is a better measure. You see, as I was explaining earlier, is a better measure of distribution of cash flows, although it may be less easy for shareholders to understand, because payback period is very easy to compute as well. That's why you see you've got like 100,000 investment, and then you've got like year 1, 2, and then you've got 50,000, right? And then what do we assume? Like the payback period is 2, because we are recovering this 100,000 in 2 years. But is that a discounted value? No. Is it taking account of this longer term period? No, it is not, right? Because you may have high positive value in the first year, and then in year 4 or 5 it could be minus 50,000, let's say. So the volatility is very high in this thing, right? So it could be like this 50,000 could not be even generated based on this, right? So you need to take into account of all these things. So duration does that, okay? It takes into account of time value of money as well, plus the whole cash flow over the time period, okay? So based on the way you calculate your how quick the investment will be recovered, based on all these things, your analysis will be different, okay? So the investor should always take that into consideration. Let's see the marking structure. Sales revenue 2 marks, okay. Variable cost 2 marks. I think that was the trick part, is like both of them are increasing, right? The quantity is also increasing, the price is also increasing. That's why I guess it's 2 marks. Fixed cost is simple. TAD is basically 2 marks, right? Okay. Tax payable is 1 marks. Working capital is 2 marks, okay? So we've got to make some adjustment for those initial thing, right? So that's why remember it was year 2 start, right? So that means year 1 ending. Okay, so that was the caveat over there, nothing else. And then NPV of the project, comment on NPV as well. Okay, comment on NPV. Remember, I did not read that properly, but it did say comment on NPV as well. But did it say? I just want to check. Comment on investment duration, calculate and comment. Okay, so they mean for both of them, right? Evaluate. Okay, and then duration calculation is there. Comment on duration. What was the formula for duration calculation? It was present value divide by your total present value times year plus, so for other years as well similarly, right? So comment on duration. I'm just showing the way they did it, right? You could do it other way as well. So reduction in selling price, right? So we have to calculate that. That's for 3 marks, right? We need to take into account of tax and just discount it, right? And then we need to discuss it. 2-3 marks, that's good. Some, yeah, we 2-3 marks. That's why they talked about all this failure kind of stuff as well, right? It was in the question as well. Significance of NPV. Okay, we're getting 1 to 2 marks. Shareholders' attitude to short-term and long-term risks. Time frame measures. I think we can answer this thing very easily. This thing is also very easy. Time frame measures also, it's easy to miss, but yeah, this is also, if you know about duration and all, it's very easy to score the marks, right? So that's pretty much it in this particular question. If you have any doubts regarding anything in this particular session, do let me know. I'll definitely be happy to answer it for you. Yeah, that's it for this video, and please don't forget to like, share and subscribe. Take care. Bye bye.